Well, 2014 is shaping up to be a significant year for Australia's economy. The government's set to hand down its first budget. The Aussie dollar is tumbling. Interest rates are at an all-time low. But is this good or bad news? And to tell us more, we're joined from Canberra by the Managing Director of Market Economics, Stephen Koukoulas. Stephen, good morning and Happy New Year to you.
Good morning.
Let's take a look firstly at the US, and as the year came to an end, really good signs of recovery happening there.
There are good signs. We've got to remember that the US is still roughly a quarter of the world's economy. It's a big part of the world, so what happens there does matter. We've got job creation coming back, we've got housing turning higher in the US, and we've got the Federal Reserve starting to scale back their stimulus. So it's a sign that the economy has some self-sustaining upswing, and if the US can grow at about 3%, that would be a very good sign for the world economy and a very good sign for Australia.
Why will it be a good sign for Australia? Of course, we've seen the Aussie dollar tumble, and that's always a key indicator, isn't it?
Yeah, well, a strong US means that demand for commodities and just general demand and financial market confidence is probably being sustained. The other thing, of course, yes, is the weaker Aussie dollar, and we're seeing already with this move to 90 cents or a little bit below as we are this morning, some of the confidence coming back in the export sector. Tourism, we're hearing stories of an upswing in activity. We Australians are tending to stay home. It's more expensive to go overseas. And foreign tourists are increasingly looking towards Australia as a less expensive destination. Things like that. We've got education services also starting to look a little bit stronger, but just good old-fashioned exports, the mining exports, they're doing a lot better, even if some of the prices that they're getting for their commodities is falling. The weaker Aussie dollar will offset that negative shock.
And before we talk a lot more domestically, of course, China's still playing into that. Still solid growth, even though the figures have come off substantially compared to recent years. But you're still seeing a lot of really good growth in China.
Yeah, that's correct, yes. Growth is softer. It's not as robust as it was a couple of years ago, but still around 7.5% for GDP growth in China in a much bigger economy is still quite a vibrant rate of economic growth too. And we've got to remember that China takes about 1/3 of our exports, so the stronger the Chinese economy is, the stronger demand for our exports will be as well. Another important part about China is, of course, it's the Western consumers that buy a lot of their manufactured goods. So taking that back to a stronger US economy and even a mild recovery in the Eurozone, that's going to be a source of demand for Chinese manufactured goods. That feeds back into the Australian economy. So that's why the world economy really matters to us.
It's so critical. So let's come back to Australia. And of course, in the first few months of the Abbott government, we saw Joe Hockey really just, I guess, positioning himself to be the deliverer of bad news. We've seen the departure of Holden, the manufacturing industry is taking a big hit. How are things really looking for us in 2014?
Yeah, look, well, obviously Mr Hockey's playing politics and, pardon me, not economics. And we've got, aside from Holden and those sorts of things, the hard economic data on the economy is actually pretty good. We've seen retail sales moving a little bit stronger. We've seen housing construction activity picking up. And things like consumer sentiment and business confidence measures, while they're very fickle from month to month, they're both higher now than they were a year ago. And that says to me that the overall bottom line of the economy is actually not too bad. Certainly stronger than the Reserve Bank are thinking, and probably stronger, almost certainly stronger than was put in the mid-year fiscal outlook last month.
I was surprised to see Bob Hawke yesterday, though, urging Tony Abbott and Joe Hockey to be very careful about the debt and saying that, you know, this is a serious problem, the growing debt.
I think it's overstating to say it's a serious problem. I'd call it more of an issue, that unless we do something about it or the government does something about it, it could become a problem. But that's more to say that when the budget does come up in May, in 4 months' time, you know, I'd be the first one to advocate some trimming in expenditure and some tax changes, not for any reasons of problem with the budget. We've still got the AAA credit rating, of course, from all three rating agencies, but more just to move the budget to a slightly more sustainable footing so that if, maybe not this year, but the year after or sometime down the track, we get another negative economic shock, the government's got the money in the bank to do some fiscal stimulus measures if the worst happens. And if the economy keeps growing, well, then there's nothing necessarily wrong with running a few budget surpluses and having a very low level of government debt still.
Stephen, we saw quite a positive picture over Christmas emerging with bumper retail sales for the first time in 5 years, a really good year.
Yeah, and that's what I was touching on before. Even before the Christmas sales, which appear to be very, very strong, we had an upswing in consumer spending. Consumer spending is well over half of Australia's GDP. We consumers in the last few years have been very cautious. We've been running down our debt levels, we've been increasing our savings, and we've just been very cautious about our new spending. I think the point's come where we've probably saved enough money. Our level of lower debt is giving us some comfort in terms of borrowing more. Just the other day we saw some credit figures for housing, which is moving higher as well. So we've got this scenario where a confident consumer is starting to come back, and when consumers have got lots of cash in the bank, their wealth is going up because house prices and the stock markets are pretty strong, then of course they're going to spend more money. And I think that's what we're seeing. So I'm reasonably confident that consumer spending will not only be strong over this Christmas period, but right through 2014.
Going to continue. One of the bad news stories of this period has been petrol prices. Yeah. I mean, is it just gouging, or is it simply that things are, because the Aussie dollar's coming down, things are going to go up and prices are going to get higher?
Look, week to week petrol prices are all over the place, but I think there are two critical factors that suggest that petrol prices will be higher this year and certainly in the short term, and that is the lower Aussie dollar. All of our oil and petrol basically are imported, and the world oil price is still hovering around that $100 a barrel. So very simple mathematics is that the higher the oil price and the lower the Aussie dollar, the more we have to pay at the petrol pump. So again, while yes, week to week there might be some let's call it positioning from the petrol companies around the holiday period, but I think more longer term, once the dust settles from all this volatility, that I think we are set for a period of higher petrol prices, and that in itself, adds to some of these inflation risks, and probably means that the RBA is more inclined to hike rates than to cut rates this year.
I was surprised by the Abbott government's, I guess, approach when Holden left. They didn't seem to be as concerned, the feeling that there would be other jobs created. When you're looking at the outlook, do you think the jobs are going to be there for these many people that have been losing their jobs?
Look, as I said, the economy's doing okay, and even over the last year when the economy has been soft, that there's still been some rate of job creation. To be sure, it's not fast enough to see the unemployment rate fall back below 5%. But we've got to remember too that a lot of the areas where there is expected to be some reasonable strength in the economy this year, that is consumer spending and housing construction activity, they're quite labour intensive. They employ a lot of people, unlike mining, which is high output but low employment. If we get this shift towards consumer spending and construction, they tend to have a high level of labour input into it. So I reckon that the labour market's going to be doing okay this year, and hopefully it's going to be strong enough to absorb some of the job losses that we're seeing from Holden and some of the other manufacturers that are clearly under pressure.